Welcome, everyone. People are just rolling in, so I'll just give them about 30 more seconds and then we will get started. All right. Well, thanks everyone for being here. Really excited to talk to you today. I'm Alex Shore, managing partner of GridVest Partners. Got a pretty fun webinar here for you, really focusing on how to navigate battery storage procurement with all of the interesting things going on the policy side, on equipment side, pricing wise. And I've got some great colleagues here to help me through this and share what's going on in the market. So in particular, we're going to be zooming in on how to safe harbor batteries this year, since it's not too late. And yeah, a little bit more about GridVest. So with that, I will dive in. And one of the main great things is I get to have two other colleagues of mine here. So I will let James nicely introduce himself. He's a sales director at GridVest. And then we'll hand it over to Liam O'Brien for a brief introduction. So James, to you.
Hey, I'm James. Hopefully you've spoken to me before or met me before. That if you've ever spoken to anyone at GridVest before, that's partially my goal. I think three times running annual most well-liked GridVest employee of the year. But I'm here for any of your needs on projects and getting pricing, indicative pricing, finding the right fit for your project, et cetera, et cetera, et cetera. Liam?
Yeah, thanks. Well, I'm gonna compete with you for that employee of the year. But anyway, so my name is Liam O'Brien. Some of you might know me. Most recently, I was at Solarc managing the CNI product team, and then before that, I've had experience in battery storage, EV charging, and also installation EPC in the renewables industry, where I've been for about a decade.
Great. Well, I'm going to talk you through the kind of opening here and more about what we do. And then we'll hand it over to James to take you through the policy side, and Liam as well. So main thing to mention today is really that the energy transition is accelerating, right? We all know that. Renewable energy is continuing to grow no matter what happens on the policy side. But there's a lot of uncertainty. And so I think right now the OBBB has been a kind of a rude awakening for a lot of developers and project owners who are planning to use tax credits for solar and battery storage projects, and has introduced a lot of changes. So accelerating a lot of purchasing has been one of the biggest things that it's done in order to safe harbor or starting construction. And right now there's a little window of opportunity to safe harbor this year, lock in tax credits if you are going to be using FEOC products, so batteries or other equipment that comes from foreign entities of concern. And those are, we're confident that we can make sure that those are compliant this year if you're locking in the tax credits through safe harboring, or there will be some FEOC compliant options next year, but those are going to be quite a premium. So if you can lock in projects today and equipment today, we highly recommend it. So we'll talk more about that. And what we're going to be talking about is really high level about what developers are facing on the ground, the new policy landscape, the practical steps to de-risk and move quick, how GridVest can help, and we'll finish with about 15 minutes of Q&A at the end. So thanks for being here. And yeah, hope you'll stick around to the end, because I think there'll be some interesting discussions as well. And we will record this, so if you do need to drop, you'll have a recording in your inbox. But before we begin, we wanted to start just to see, where are you in the battery procurement process? We want to get a sense of who's on the call. So we'll be launching a poll that you can answer in just a second. And I will be kicking that off. And so if you can fill out your answer here, or where are you in the battery procurement process, that would be great. Just give you 15 seconds. Everyone's seeing the poll? Oh, no poll. Okay.
Yeah,
well,
it's not popping. Oh, it just popped up for me.
There we go. Interesting. All right. So we've got a nice little mix of people here. Equipment, quoting, and procurement in the lead. And have not started is on there, planning an early stage. Okay. So there's a lot of people who are looking at battery procurement right now. And I'm going to end that and share results so you guys can see where we are. We're about 52% of the people right now on this call who are we're looking at quoting and procurement of battery storage. So that's really helpful. We will be talking to you in particular, and we'll be a few other polls later. We can get a better sense of who else is here with us. So just a quick background on GridVest, right? We are a battery storage procurement platform. We're distributing battery storage equipment mostly for the CNI and distributed and utility scale markets. So projects as small as 40 kilowatt hours, but as large as 400 megawatt hours. Typically, our average deal size has been between 1 megawatt hour and 5 megawatt hours, but we're starting to see bigger and bigger projects as that is one way developers are actually getting managing decreasing returns on project investment. They're actually increasing the size of the project to make up for that, as well as using additional leverage and ways of cutting costs through procurement channels like ourselves. So we provide integrative quality assurance, commissioning. We make sure that these batteries are all that work well together, battery and EMS and an inverter that's going to actually work. We've heard about all kinds of horror stories in the industry. We have learned from those. Liam can tell you a little bit about how we do that later on in terms of making sure these are integrated solutions. And in particular, we go direct to manufacturers. So we are getting the best price that you can possibly get. We typically are buying in bulk, so we can also get better terms. And we have our own financing. So we provide flexible payment terms that we don't really care about what your credit is. We just care about where is this battery. And so we're essentially asset-based lenders, which is a very unique thing in this industry. And our cost of capital is really low. So it's all embedded in the price. You don't have an extra interest rate or anything like that. It's just a really simple way to reduce the upfront cost of batteries. And we can help manage all the logistics and warehousing, as well as just making sure that the commissioning goes really smoothly. So that's kind of GridVest in a nutshell. And where do we sit in this, in case you're still a little unclear? Like, this is kind of where we are in the ecosystem. On one side, you have the direct to manufacturer route, right? You go call up a manufacturer. It's pretty tough because they don't typically want to sell to smaller projects. They typically are quite difficult to work with, and you're not really going to get a full integrated solution. You're just going to get a bunch of pieces. On the other side, if you go to a full turnkey provider, they're great for many reasons, but the problem is you're going to pay quite a premium. And so what we are doing is providing that nice middle ground where we're doing more than just this typical brick and mortar electrical distributor who just sells parts. We are selling full solutions. We back those solutions. We make sure they work really well, but the batteries, inverters, and EMSs do not have our logo on them. You're getting a brand from a tier one manufacturer, and we are just there to make sure that that project and that product works really well. So with that, I'm going to hand it over to James to allow you to hear a little bit more from the field. James talks to developers and EPCs every day, and he is dealing with a lot of people who are basically under a time crunch and figuring out, how do I safe harbor? How do I feel good about safe harboring so I know that I'm actually going to lock in the tax credits, and what else can be done? So James, I'm going to hand it over to you to talk us through what's going on. But maybe before we do, we can do one more quick poll just to get a sense on where people are and what is currently your biggest hurdle for implementing battery projects. So we will launch that, and here we go. So we're already getting some good answers here. So right now it's all pretty even. Let's see, anyone else? I'll give it another 3 seconds. 3, 2. All right, it's pretty split right now. I will share the results here and poll, and so you should be able to see the results here. We are basically at the leading one is equipment research and selection, so that's 26%, and navigating permitting, adhering to critical timelines are the next two. So yeah, interesting to see what's going on in people's minds. So James, I'm going to hand it over to you to help enlighten this group of how, what's the developer dilemma?
Well, if you came for enlightenment, I don't know. Let's set our expectations slightly lower. I think, look, this doesn't surprise me. I was really curious to see where this poll would come in. I think the part that doesn't surprise me is just that we're very split across the board. The only one that no one voted for is sourcing skilled labor. Everything else was pretty much like 20, 20, 20, and 12% across the board for access to capital, equipment research, permitting, critical timelines. I mean, look, I think this sort of paints the picture that probably everyone on this call already knows, is that, this isn't really for the faint of heart. It already wasn't easy, and I would say that this year it got a lot harder. And the name of the game is uncertainty, right? There's a lot of macroeconomic uncertainty. Then there's a lot of like microeconomic uncertainty on each individual project with each AHJ, or what this fire marshal thinks is the hill he's going to die on. And honestly, like, that is what I see across the board. And I think, every single project, especially in this size of battery scale, although it's not completely unique to CNI, every single project sort of has its 2 or 3 big hurdles that our customers are trying to overcome. But from project to project, what those 2 or 3 hurdles are can really vary across the board. Certainly, there's a lot of obstacles with financing and capital, especially now with uncertainty around the ITC. That all bleeds into the procurement problems that everyone has. Am I going to safe harbor? What is my tariff rate going to be? What is my lead time? And how do I try to make the planets all align so that every single one of those things, hits the perfect timeline it needs to hit for this all to happen? So I have seen all of the above across the board, and I think the projects that get done typically get done because developers are really clear in communication with all the stakeholders, their capital financing partner, their end customer, ahead of time. And so they're sort of prepared for what these challenges are. And because they're prepared there, the second that the right opportunity hits, like right now is a 90-day pause on tariffs, right? And they already know what their equipment they want to do, and they've sort of scoped it out. Well, they're ready to pull the trigger that second, so that they can get this imported and know what their tariff rate is going to be, right? That's an example of an actual project that happened. So I think, trying to be thinking far ahead early on in your timeline, you don't have to have a solution for this, but just be aware of, what are the potential things that could come up, so that you can, fundamentally be flexible and fast in the moment that you need to be, fast. Alex, anything else that you would add to that before we pass it over?
No, I think you covered it well. I think it's really just about focusing on what you know right now. And what we know right now is that safe harboring locks in tax credits for next year. What we don't know is what the situation for FEOC compliant product is going to be in terms of lead times, in terms of price, in terms of who's going to actually get the UL certifications. And there are some options out there, but again, it's just, I think right now there's an opportunity to lock in lower cost equipment and projects going forward. So to me, it's just really focusing on that, because again, as Liam will talk about, some of the guidance hasn't even come out yet. So we're basing a lot of assumptions about what will be FEOC compliant based on what we know today, but it's still not 100% certainty. So just want to reiterate, the certain thing is about safe harboring now, which that is a certainty.
Yeah, I think it's actually a really good point, which is, the big picture is uncertainty kills projects. And it kills it because your capital provider doesn't feel certain about, what they are trying to hit, or they don't feel certain about tariffs, or you don't feel certain about it, or your end customer doesn't feel certain about it. And because everyone is so uncertain, then people don't feel comfortable in the moment when they need to move fast, moving quickly. And so I think what our customers who are successfully getting projects done are doing well right now is they're sort of honing in on what are the key things. And then the second that they see that right window of opportunity, like they've already sort of handheld and done that communication with all the different stakeholders. And so everybody's on board to say, this is what we know today. And so we're ready to make a decision today because we don't know what's going to happen next week. And we didn't know what was going to happen last week.
And what do you think, James, is the easiest way or the easiest kinds of equipment to use to safe harbor at the moment?
Yeah, I mean, I think inverters, I mean, transformers, but not as much anymore because everyone went after transformers if it was a front of meter project. And now those timelines are kind of spread out. Probably inverters. And then depending on the size of your battery project, there are certain supplies of batteries that are either in the US right now, which makes it easier to safe harbor, can be manufactured quickly, and or are on a container on their way already. And so, just trying to have that certainty of, am I going to be able to get title or, pay a whole 100% to get to that stage, and by the end of the year, and or take possession within 105 days. I mean, I think, probably inverters is the easiest one, but on smaller projects, there's certainly probably some easier pathway forward with just the battery itself.
Yeah. Great. All right. Well, thank you for that. And we'll kind of dive into this a little deeper, but I think we want to go next into the market and policy side with Liam O'Brien, who will give us a little bit more context in terms of what's really in the writing. So what does it say, and what does it mean? So Liam, I'll hand it off to you.
Yeah, thanks, James and Alex. Yeah, so I think really, the big thing for me is that storage over the past 2 years has seen tremendous growth, and I think you can see the numbers prove that. So I've got a couple different numbers on the screen, but I think one that's very interesting from SIA and Wood Mackenzie is that you can see annual additions of new generating capacity. And so we just filtered out and we're looking at storage, wind, and natural gas. But you can see already in the past 2 years, storage additions to the grid have outpaced natural gas, and they're now almost at 60% a year. So lots of new storage is coming onto the grid. You see places like California where there was like maybe a gigawatt in the entire state a few years ago, and now there's almost 8 gigawatts worth of storage on the grid. Helping to ramp from daytime peak production to evening ramp from load. So I think if we look at overall deployment in the U.S., just in C&I, we had nearly 2 gigawatts worth of commercial solar in 2024, and that would represent 18% year-over-year growth. I think initially in the first half of this year, I think we were actually going to almost 25% year-over-year growth. We've got targets for 2030 that are hovering somewhere around 132 gigawatt hours worth of total storage capacity needed. I think in many cases these targets are wrong, and they're usually wrong because they're too small. Typically the number actually is a lot higher. But you can see even with some of the market forecasts, Wood Mackenzie is looking at adding at least another nearly 70 gigawatt hours of storage by 2028. So I think the big takeaway is just storage is really booming. The challenge is that there's a lot of bottlenecks that we've had introduced this year. So we've had things like tariffs. We now have FEOC and domestic content issues that have come up with the new administration. So I think there's a lot of promise, but I think there's a lot of challenges of actually deploying it in the real world. So we'll go ahead and go over. So big thing is FEOC and to a certain extent PFEs. So there's a lot of acronyms. FEOC is Foreign Entities of Concern. And really that encompasses a couple different countries, including China, Russia, North Korea. Really for our purposes, China is the biggest one because China dominates the sort of global electric manufacturing space. So whether that's motors, critical minerals, battery storage, I think somewhere on the order of 75% of lithium batteries are made in China. Or certainly in Asia more broadly. So that's definitely a challenge for our industry. And then if you look at PFEs, which was something that came out of the BBB, that's sort of a broader list of both countries and then also specific entities and companies. And so they're barred from participating in certain business. I think a lot of people are very familiar with Huawei in the telecom space. And so we're seeing a sort of similar situation in battery storage. So I think one of the other massive issues with FEOC is ownership thresholds. So a lot of companies are now trying to sort of shift their board seats around and try and dilute Chinese ownership. But it's very challenging to stay below a 25% threshold. And certainly if you have multiple minority stakes that might be under the 25%, but if they add up to over 25% in aggregate, that could still be a problem. So I think a lot of developers are now having to really understand, what is the company that I'm doing business with? What is their ownership structure like? Which a lot of people, it's very opaque to get that information. And it's not something a lot of developers are used to dealing with. The other thing that we've had somewhat related to FEOC has been domestic content. That's sort of been more of a carrot. So if you had domestic content in battery storage, you were able to get a 10% adder on the ITC. But what we're seeing is a lot of those sort of sourcing limits and weights for domestic content are now, I think, kind of shifting to FEOC content, and are now sort of thresholds for how much foreign materials and foreign parts that you can have. And so really the takeaway from this is that if you buy batteries from a foreign entity such as China, the overall risk that you have is either not getting the 30% ITC tax credit at all, or potentially, if you're not careful enough and diligent enough in your paperwork gathering, there's a potential that if you get audited, those tax credits could be clawed back, which is a major risk, I think, for a lot of developers. So some key dates and milestones. Obviously, biggest one that's sort of looming right now, January 1st, 2026. That is when these FEOC restrictions take effect. This is part of the one big beautiful bill. And so this is going to basically just sort of escalate in severity over the next couple of years, depending on whether you're doing solar or just storage projects, or solar and storage. Wind is also part of that. But really, you've got until December 31st to safe harbor those projects, preferably sooner. But definitely before then, because once we hit January of next year, you're now going to have to take these sourcing considerations into account if you want to claim that ITC. And then we have a couple other dates. So, if you're foregoing safe harbor, you've got to basically be complete with your construction by the end of next year, so December 31st, 2026. And then more broadly, if you do have safe harbor, most of those projects are going to have to eventually wrap up sometime in 2030 to stay within that 4 years of construction start. Now, there are some continuity exceptions to that. So if you can prove that there were significant delays in construction, there's ways that you can sort of file for variances to that. But if you want to keep things simple, basically the clock starts and you've got 4 years. And then by 2033, sort of an interesting carve out in the BBB was that storage actually got a longer tail for the ITC credit to remain in place. So solar tapers off quite quickly. In fact, next year for residential, it's entirely gone unless you have a lease product. But for commercial storage, that's basically been kept around until 2033. So there's some, potential upsides, but I think the whole industry has been very shaken up by this overall. And so really, like if you're dealing with these FEOC restrictions, this could mean the difference between, getting that 30% and having a project that works out financially or not. And so that's definitely a major risk for a lot of developers. So I think, sifting through the chatter, certainly we've got, nearly 77 people on this webinar. I've seen some other webinars with, even higher attendee counts. I think everybody's kind of searching for a magical crystal ball that will tell them what they need to do and when they need to do it by. I don't think right now there's really any crystal balls, unfortunately. I think everybody's kind of trying to use the existing guidance that was already present. There's been some updates from the Trump administration, but otherwise it's quite messy. And so I think, the existing approaches that we have are kind of using the safe harbor tables that already existed and have been updated and modified more recently. Also, some companies are trying to use the direct cost accounting equation so that they actually look at the direct cost of the materials and their sources. I think that gets very complicated because, as most people know, we have a very global supply chain. So every single little component that makes up an inverter, battery storage system, down to cells, containers, packs, modules, BMS, cooling system. There's a lot of components in there, and they all have different vendors and sources and origin countries, and certainly even contracted vendors underneath that. So I think overall, there's a lot of different ways to look at this. The big thing I think we want to focus on is don't try to hit an exact percentage. Don't look at the safe harbor table and say, all right, well, I'm going to go right up exactly to 55% and that'll be good. Because again, there's a lot of variance or sort of gray area in these rules. And so if you're trying to hit an exact number, If the guidance then later comes out to be more stringent, then your project is over the limit. So I think, leave some leeway, and definitely, try to be a little bit conservative. But there's just a lot of risks, I think, as we go through this. Obviously, things might get better as we go into next year when there's some more guidance. But right now, the preliminary content thresholds are really based on the domestic content thresholds. So these are the same percentages that you would have had to meet to qualify for domestic content adders. Right now, as we go into 2026, that would have been 60% domestic content for solar and wind, or 45% for battery storage. If you just take those same thresholds and flip them around, these are, what we consider to be likely thresholds for PFE. Now, it could be more stringent or it could be better. We don't really know. Things kind of change on a weekly basis in the administration. But this is sort of a conservative guidance, I think, as a baseline. But really, the big takeaway here is just having an assembled in the U.S. battery may not be enough to really qualify you. So I know a lot of companies are out there. They're opening up manufacturing facilities. They're creating U.S. entities to build in the U.S. And that all is great, but in many cases, they're simply shipping, components or assemblies to the U.S., maybe doing some final assembly, and they're saying it's made in the U.S. That really may not generate enough either domestic content if you're trying to go for domestic content adders, or in this case, for FEOC restrictions, that might disqualify you because there is still foreign entity content, typically from China, in that. And so here you can see a slightly more detailed breakdown. But again, I want to reiterate, these are preliminary guidance based on the domestic content. We still don't have a table like this for PFEs or for FEOC entities. And the IRS doesn't think that they're going to have that until late next year. Unfortunately, developers have to build projects today, not next year. So this is sort of the best we have right now. If we actually kind of double click into this a little bit, I think there's some interesting, call outs here. One is that larger projects and smaller projects do get treated differently. So small what I'd say sort of behind the meter projects, if we take those same domestic content percentages, they would only have to have their cells weighted at about 26%. So this is the safe harbor table. And so if you apply that to, a FEOC entity, basically what it's saying is, that battery cell coming from China only accounts for about 26% out of a total of 100 for that project. And so that's a lot more flexible than, say, the over 1 megawatt hour, which is starting to get into more industrial or utility scale, where basically half of your safe harbor, content value is in those cells. And so if those are Chinese cells, there's basically no way to make that math work. So it's very, very challenging. So there's some interesting potentials for small projects where you potentially have, maybe Chinese cells that are assembled in the U.S. or assembled in Mexico or other non-FEOC country. And if you were to, buy that Chinese cell and then package it in a non-FEOC container with battery management system, with thermal management and an inverter, potentially that could get you to that 45% and stay under that 45% threshold. So I think where the policy meets reality aspect of this is that there's really a big compliance gap. Companies have been kind of plunged into becoming experts in tax and legal code, which I know when I got into the industry, that was not my main thrust. I wanted to build projects, and certainly working for manufacturers, manufacturers want to build products. And so all these additional, paperwork and red tape add-ons don't make it easier. And so I think what we're really seeing is that you've got to be careful because, just having a US-based intermediary, so lots of Chinese companies have set up, their company name, Inc. in the US, that's not necessarily going to satisfy FEOC rules. Also, interestingly, a lot of companies, especially the larger ones in China that are, very large brands, they're trying to basically divest their assets and sell them off so that they stay below that 25% equity stake in them. The challenge is that the Chinese government in some cases would be likely to block these sales because these are considered critical industries in China. So again, even if a company wants to try and sell it off to meet these obligations, they might get blocked in China from doing that. And then obviously, there's a lot of timelines flying around. I think companies are quite aggressive in when they think that they're going to have FEOC compliance. And so there can be a lot of uncertainty where a manufacturer might quote a certain date for having product that is compliant. I've seen a lot of dates quoted, beginning of this year. Already those have started to slip. I had some people telling me, oh yeah, we'll be ready by Q2. And already that's going into Q4 of next year. I think financial impact overall, like there is growing capacity that's not made in China. So we have obviously some things in the US, although that's sort of imperfect. I think there's been a lot of battery factories that were going to get built, and then due to the uncertainty in the overall policy climate actually got canceled. So it's kind of the BBB has had sort of a negative effect in that way. And then we also have, places like South Korea or Mexico, who would be, non-US, but still non-FEOC. But I think really, even in all of those cases, you're going to expect at least a 20 to 30% cost premium is what we're seeing initially. And that's going to vary based on manufacturer and where they're building this, but it's going to be more expensive. So just assuming that, hey, we'll just buy a FEOC compliant option, no worries. Yeah, you might get a tax credit, but almost all of that value could be eroded by the fact that the initial cost is 30% more itself. And so, and then the other challenge here is for tax credits. If you are selling those to an off-taker, in many cases, they require insurance to make sure that in the event that the tax credit gets clawed back, they don't have any risk. The challenge there is that the insurers might be, even more stringent than perhaps an IRS auditor in looking through your supply chain. Because if they're going to insure that project and insure those tax credits, they want to see, what is your supplier and what is their compliance strategy. And so this is where I think another big key question to ask is who is trying to use the tax credit that you're claiming? So is that the asset owner or is that an investor and third-party off-taker? Because they're really going to set your strategy for FEOC compliance. You certainly could say, well, I'm going to do this clever thing that I've thought of, but really the question is, what is their risk tolerance and what are they going to allow you to do? And so I think that's a question you want to ask pretty early on in the process. So just to kind of give you the easy flowchart version of this, so for safe harbor, you've got a couple different options of how you can actually approach this. So for small scale projects that's under 1.5 megawatts AC, you have two parallel paths to getting safe harbor. So you can either put down 5% of the total project costs, and again, you want to make sure you got good receipts, good invoices, lots of paperwork trail to prove that if you get audited, and then you need to start construction and place that in service before 2030. Another parallel option is if you're ready to go and you've got this project all lined up, you've got your permits in place, you can actually begin physical work. So that's the physical work test, and that's pretty tried and true. And both of these have been part of the tax credit for a long time. And so that could look like, installing racking, pouring a foundation for your battery, anything significant, and structural on site. If you've got, electricians, other contractors showing up to do work on the project site, that's a physical work test. And again, same details for placed in service. Large projects are a little bit more complicated. They do not have a 5% down. You can only start those with a physical work. And so again, that's usually less of a problem because if you do have a large, multi-megawatt AC plant, typically you've got a lot of structural work to do, installing piers, installing racking. And again, got to start physical construction before July 4th of next year. And so again, for all of these small and large projects, if you get them started this year and into next year, you do have to place those in service within 4 years of the start of construction. So that would put you somewhere at the end of 2030. Again, there's some exceptions to that. You might be able to get extensions, but keep in mind, if you do ask for those extensions, you might be more likely to get audited and you might need to have, sufficient paperwork to validate why that was a valid extension.
Yep. And Liam, I'm going to jump in really quick, if you don't mind going back for just a second.
Oh yeah, sure. Let me jump back.
I wanted to just add two points here. I think you did a great job covering it, but 2 points just to call out. One was that I think the physical work tests can potentially start off-site. So if you are guidance we've gotten from our legal, and again, check with your own lawyer, is that you can, if you're doing let's say a transformer or a skid that's being built off-site, and there has been enough man hours this year that have been implemented and enough of a significant amount of cash has been spent on that, it's possible to claim that as a physical work test, even if it's not on your physical site, because that is being custom built for this project. So that could trigger the physical work test for those, especially for those larger scale projects where you might not be able to use the 5% safe harbor. So that's something that to look into and consider. And yeah, so I just wanted to make sure that was called out.
Yeah, and definitely I know a lot of contractors are trying to do, prefab and pre-assembly where they can. So whether it's something as simple as creating a unistrut frame and attaching balance of system materials so that they're ready to go on site, they can just be dropped in and the wiring completed. That would also qualify. Again, anything that's fairly custom and unique to the site. Although even transformers, I think we've seen a lot of people try to use that, but obviously now that's a little bit of a long lead item, so that might be less applicable as we're getting into the year.
Yes, solar modules could be another one for the 5%. Just one last thought that came to mind too is about the piece of the basis step up. So I think you mentioned this earlier, Liam, but I just want to reiterate it around that percentage that you need to safe harbor. So if you're going to end up selling the project, or you want a tax credit for the entire let's say developer markup and everything, you're going to need more than 5% of the actual physical cost. You're going to need to have 5% of the total project tax credit that you hope to get. So just another point I wanted to reiterate.
Yeah, and so this is where we kind of get into some detailed tips, sort of breaking down. So this would be for under that 1.5 megawatt AC, these two parallel paths of either 5% or physical work. And so really, again, to your point, that's purchasing qualifying equipment, or that could also be offsite fabrication. And so this could be a good option for purchasing inverters up front, purchasing transformers, battery storage, obviously, any other components that have a fairly significant cost. And so you could also begin site clearing, because this does cover the total project cost. So that could include custom engineering, site work and prep. Anything construction related is definitely going to be considered eligible. And I think to your point, you could also add in sort of indirect and shared overhead. But I think you might want to be careful in not applying that all up front. You might need to actually segregate that out based on project invoice level. The other option would be physical work, obviously. So again, offsite fabrication would count. Really, the key things here are just making sure you have signed contracts and POs. Everything is dated. You've got a paper trail. Getting upfront payment for things, getting records. So whether that's test results from factory acceptance test, progress photos from on site, maybe having an independent engineer come out and do evaluations. If you have somebody coming out to inspect the foundation, basically just as much paperwork as you can to prove that there are indeed people on site doing work. And typically the industry standard that we've seen, again, don't quote us on this, you can talk to your own attorney, but typically about 200 hours of physical work is sort of commonly accepted as sort of the minimum bar. And then, again, qualifying years when the physical work happens. So if you do work this year, that would start you off in 2025. So then if we go to, one other additional thing I think is helpful to point out, depending on, I want to clarify, depending on your accounting methodology, so whether you're cash or accrual basis, if you are on an accrual basis, and this is under GAAP, if you claim the equipment, if you purchase that, you put 5% down, let's say in 2025 to get your safe harbor, that equipment does have to arrive within 105 days. And when I say arrive, that could mean physically on site, that could mean gets to your warehouse, that could mean you take title and you complete that purchase. So you basically have about 3.5 months, which I think puts us somewhere in, is that April, I think, Alex? If you were to sort of buy now.
Yeah, April 5th, I think. Somewhere
around there. So if you were to buy now, put that money down, you have to take delivery by April to really have that still qualify under GAAP. And again, important thing to note is that does not have to be delivered to site. That could be delivered to a third party that you are in control of. Basically, if you take possession of that in the legal framework, then that would be considered assignment to you, and then you would be the owner of it.
And I would just add that if you have concerns about would you purchase your make and qualify, ask your accountant, because ultimately this is an accounting question about can you recognize this in your 2025 financials. And there are, depending if you're a cash accounting company or accrual-based accounting, you have there's different scenarios and different mechanisms for ensuring that that you are able to claim that in your 2025 financials. So full payment is an option, title transfer is another, and then again, physical delivery. Those are all ways to trigger but again, check with your accountant and see what they tell you based on your unique situation.
Yeah, and definitely if you are under cash accounting, then you would have to do that full payment to really recognize that. I think a question to come up was that site prep may not necessarily count. So like site grading, again, this is one where you kind of have to decide for yourself. I do think there are some exclusions. So if it's not, if you're just doing maybe some landscaping in preparation for that, that may not qualify. But certainly if you're pouring a concrete pad that the batteries will sit on, or you're installing a fence around the PV farm, that is custom and unique to the project. And I believe that would count. And again, this is a case where the minimum is 200 hours. I think the more, evidence you can kind of stack in your favor, the better it's going to be and the easier it's going to be if you were to get audited. I mean, basically, can you sit with a straight face and tell an auditor, yes, we genuinely started work on this. Are you comfortable doing that? Yeah, so I think just kind of getting some high level stuff. We've talked to some different legal partners that we have. Obviously, we recommend you talk to your own. We're not lawyers. Certainly, none of us can pretend to be. But I think some takeaways that we've gotten from those conversations have been smaller projects are potentially safer from compliance and risk management. So again, smaller meaning sort of under 1.5 megawatts AC or one megawatt hour. That can just be safer because again, you have more options of either the 5% or physical work test. Domestic content percentages are different for those two different categories. Again, ITC eligibility depends on whether you have FEOC compliant product. That is somewhat complicated right now because we don't have really definitive guidance. But one thing I think is interesting and did not change under the BBB is that renewable projects can still benefit from MACRs, or the Modified Accelerated Cost Recovery, basically accelerated depreciation on assets. So that has not changed at all. That's been a sort of very basic part of the tax code for renewables for a long time. So for a lot of businesses, that means instead of taking this 25 year PV asset and having to depreciate it over 25 years, you can take all of that depreciation within usually 5 years. Likewise for battery storage. So that's kind of a nice bonus, is that even if you say, well, I don't get any ITC eligibility, you can write down the value of that asset much quicker. And that could help, improve the project, finance and cash flows. Again, you got to have detailed records for audit defense. So if you're relying on the 5% test, make sure you have, receipts and invoices for the assets that you're buying. Again, records is really, I think, what we've heard over and over. Lawyers love paperwork, so make sure you get lots of paperwork. Work with suppliers and vendors that you trust. I think it's really important now to figure out what are, the delivery terms and timelines. Making sure there's enough time, depending on your accounting situation, to take ownership of that product or pay in full. And then can you actually get that delivered on time? And certainly if you're trying to do physical work and meet that criteria, you need to actually have equipment on site to be able to do the work. And so making sure you have clear understanding of when things are going to arrive is very critical. Again, as we talked about, purchasing what I'll call anchor products. So if you're trying to get that safe harbor this year, using things like transformers, inverters, batteries, potentially also even energy management system or controls for the project. That's something that's relatively easy to install early, and those can account for a pretty significant portion of the budget, depending on the scale of project. So those are all ways to get safe harbor through the 5% test, or potentially even physical work. Overall, as I think we've stated a couple times now, be very, very conservative. We don't have final guidance on a lot of this, which is very frustrating, I know, because everybody's like, well, just tell me what you need and I'll do that. But we don't have that yet. So I think where possible, err on the side of caution, do more physical work on site, spend more than 5% of the total project budget, use sort of the more conservative FEOC, percentages for content. Really just be conservative all around, because again, this could change in the next 7 to 9 months, depending on what the Treasury comes out with.
Yeah. Great.
Cool. So I think these are some of the key takeaways. Did you have anything else you wanted to add, Alex?
No, I think you covered it well, and I think we've got some Q&A or some questions coming up that we can dive deeper in. So yeah, no, it's great.
Awesome.
I can in terms of key takeaways. Yeah, I mean, I think.
Do you want to reiterate through that, or?
Yeah, I'm going to go through that slide again. I mean, I think the main you really covered it well. I think the main things to note are again, I'm going to reiterate what I said earlier, which is that focus on what you know now, right? And again, that's why I'm saying we have 6.5 weeks, 7 weeks before the end of the year. That is enough time. We have batteries that are already in the US. We have inverters that can be built within time. We have there are some transformers that are possible to purchase. So you can start, especially if the project is under 1.5 megawatts, to use the 5% rule to safe harbor. And that is a really interesting point. And the other point, which again, we need to, you should get your own legal opinion on, but from what our legal advisors have shared is that for the 1.5 megawatt rule, if each part of that system, that project, can be isolated in 1.5 megawatt chunks, there is a scenario where you could potentially make the case that those are 1.5 megawatt projects where you could use where you could use the 5% rule to safe harbor. So let's say you have a 3 megawatt project where you have two 1.5 megawatt systems that would potentially be able to use the 5% rule. So just something that you should look into. It's another scenario that I wanted to throw out. So
yeah, I'm a little bit sort of bearish on that one. I think that's that's a bit too clever. If you're trying to sit and explain that to an auditor, it's like, well, no, actually, these are different systems. But again, this is something where you have to determine what your personal risk tolerance is. And so, if it is genuinely a project that's under that, I'd feel comfortable. If you're trying to say that your 3 megawatt overall project is actually these 1.5 segments, I think that gets to be a little bit more fuzzy. But again, that's TBD.
Yeah. And I think to your point about risk tolerance, the other piece is you have to think about is who is going to own that tax credit. Because if you're trying to sell or transfer that tax credit, then the risk tolerance is going to be much lower, and how the cost to insure that tax credit, which is usually a requirement of most tax equity investors, is going to be much higher. So if you are going to use that tax credit yourself, that also is a bit more straightforward and also probably less likely for audit. But that's just an assumption, because transferring that, I think, can increase the likelihood. So again, those are things that we're giving you some tips and what we're hearing from the ground here. But do your own homework, talk to your lawyer, talk to your accountant, make sure that you feel comfortable with these approaches, because there is not a lot of these are not 100% certainty if you're playing in the middle ground. What we have here on the screen is what we are 100% confident in. So I think from there, maybe we can go to the next slide, Liam, and then we can dive into Q&A.
Yeah, sure. I think this is kind of your section, so I'll pass it off back to you, Alex.
Yeah, thank you. So yeah, really quick, we're just going to run through a final few pieces here. And the main one that I want to mention is that, how we can help right now is that, GridVest provides basically this whole battery storage system all in one contract. Here's just a few of the brands that we source from. And again, our financing, our bulk buying power, our ability to give you transparency through the supply chain, really, logistics from end to end, both in China or Malaysia or wherever, or even US, depending on where we're buying from. And basically are giving you the same access to the same manufacturers that turnkey providers are buying from. We're just not charging you the huge markup. And so this is about as economic as you can make a battery storage system, but still know that you're getting basically a turnkey product, meaning it's going to work well, it's integrated, and you have support and service when you need it. So warehousing is also interesting now, especially bonded warehouses, because that's a way for you to potentially get over tariffs, which are going to be likely increasing at the end of the year. There's going to be the Section 301 tariff goes from 7.5% up to 25%. So you're likely going to see an additional 17.5% Luckily, tariffs have basically remained steady in the current with the current U.S.-China negotiations. But bonded warehouses are another thing we can help with. And obviously quality assurance, right? We have someone on our team who's based in China who actually goes to the factories. Obviously, as the manufacturing moves outside of China, we are going to have people at those sites as well in Malaysia, Southeast Asia, like Thailand, and even eventually US. And then making sure that you're getting a good product is something that we pride ourselves on. So yeah, again, with that, I think we've already hit on this, on how we can help and how our financing works. But just to give you a quick idea of some of the example projects that we've worked on, from like the smaller size for us, which is 286 kilowatt hour project. That was a SYL Delta system that using backing up EV charging and providing demand charge management. And we did a number of schools in Southern California, which was quite a feat to get approved through the District of State Architects, who approves all public buildings in the state of California. We help the developers through every step of that process, including coordinating all of the commissioning, including working on permitting support. From the larger sides of our systems, which is microgrids in Texas. We're building full container with EPC power inverters, where for basically 2.5 to 5 megawatt hours of battery storage for microgrids and full backup capability. And so, yeah, this just kind of gives you an idea of where we play and where we can help. And so, in summary, we can move quick, we're nimble, and we will help you navigate all of the challenges with FEOC and safe harboring. And I think, as you heard today, I think you're going to get a much more straightforward answer than you'll be able to find out there in the market, because we're going to just tell you like it is. And we're hearing from all of the suppliers, all of the developers, and we have very, very good lawyers to advise us as well. So with that, last question for the day, and then we'll jump into the Q&A. Are you planning on utilizing safe harbor at all? And so we're going to start a poll here. If you could just give us a quick response as to where you land in this, it will be interesting to see. I think I have a hunch that we're going to have a pretty high percentage who are safe harboring, but let's see. And I know that the other interesting thing right now is a lot of people are safe harboring but have not started yet. So that is interesting, given that it's November 12th. And that was also our hunch and why we wanted to do this webinar, because we know that there is a time crunch and a need to safe harbor as soon as possible. So I'm going to share the results here. So as you can see, 57% of people on this call are planning to safe harbor but have not started yet. So all I can say is James is going to be busy in the next week or two, but he will gladly make time for you. So if you have a need, or you haven't already been talking to us about how to safe harbor, and don't forget, you can use our financing to help you reduce the upfront costs. We have mechanisms where we can transfer title today and pay out the equipment over time. So there's a bunch of different ways that we can structure things. So just want to reiterate that, and would love to open it up for some Q&A.
Yeah, and I would just add to that Christmas is coming. Don't wait to do your holiday shopping, whether that's for batteries or presents.
Exactly.
The later it gets, the harder it is.
Exactly. So do we have any questions that have popped up that we haven't answered yet? Let's see. I'm just checking the chat here. Or James or Liam, anyone that you wanted to call out?
Well, I was foolishly replying all to hosts and panelists to questions in the chat. Andy kindly was reposting my answers. So if you asked something in the webinar chat, I probably answered it. It just might be a little ways down where Andy posted it for me. Thank you, Andy. I'll just call myself out. That's just, I guess I'm getting
all right.
old.
I think I did that too. So,
but yeah, there's some good ones in there.
Let's see. I'm looking at our question list here. I'm going to start to maybe ask a question. There's a question here about iron flow batteries. Real quick question for you, James. What are you seeing in terms of non-lithium options? Do you think that's going to be a viable solution for people who are trying to navigate this?
I think it depends a lot on your project specifics. I think that non-lithium there's been a few holy grails people have been chasing for a while. seems like the ones that have been successful in sticking around have targeted a niche. A lot of them have targeted sort of longer duration energy storage. So I think we'll continue to see more and more non-lithium options pop up on the market. In terms of if you were going to buy one today that was non-lithium, there's maybe one or two, I would say, have either unique value adds and or deployments that are live, that give some confidence and credibility behind it. I think you'll see a lot more over time. But everyone has been saying, oh, lithium's not going to be the solution for 5 years, but the cost of lithium keeps going down so fast that I think that's just made it hard for other technologies to compete. I know that there's a company in the US that actually got a sodium ion battery installed. So that's something. I know that there's, the company in Pittsburgh that has a non-lithium solution that has some very strong value adds as well. But there's always trade-offs too.
Yeah, great. What do you guys think is coming next in terms of lead times? Like, do you think that I know there's some questions in the chat about, what percentage of developers or of manufacturers are going to have a FEOC compliant product? What do you think, let's just say, for those that do, what do you think the lead times are going to be? And what do you think the minimum order quantities are going to be for some of these companies that say they'll have FEOC compliant products?
Well, just to be clear, I think if you're trying to take title in the next 3.5 months, you're probably trying to safe harbor the project, where FEOC doesn't necessarily matter. I think if you're trying to buy in 2026, then that taking title doesn't really matter as much, but then the FEOC compliance will matter a lot more. So I think it just depends what your strategy is. If you're just going to say, well, I don't have the money, I don't have the projects right now, I'm going to wait till next year, then you're either going to have to, delete that 30% tax credit or find FEOC compliant options. Options are quite limited at the moment. I mean, there's lots of chatter, there's lots of, proposed and preliminary dates and potential stuff. But again, there's very little direct, we have a product, it's ready now, and we have all the paperwork so that you're audit ready. I just haven't seen that for most of the manufacturers we've talked to.
Yeah. James, anything to add there? Or do you agree?
Yeah, I agree with everything Liam said. I mean, I think I feel like I sound like a broken record, but I think that first half 2026 is going to be really tough. There might be one or two suppliers who can deliver in that timeline. A lot of people are saying Q4 2026. It's a crystal ball of who's going to hit Q4 2026. And again, do they mean that they can start producing in Q4 2026? Or are they going to deliver in Q4 2026? And I think there's a couple still saying Q2. So I would just say there's just not going to be a lot. Whatever there is going to be slim pickings, and you're competing with everybody for the same few units that are coming off production lines. Unless you want to buy utility scale from LG, maybe, like 100 megawatt hours plus. But that's.
Yeah. So the one thing there's a question about the 105-day rule. So I just want to go back to really reiterate, in case that wasn't clear, the 3.5-month rule. So the question was about, can you expand on the lead time? So if you need to take title within 3.5 months, and I think, so just to clarify, it's not about taking title in 3.5 months, it's about delivery within 3.5 months. You have to take title this year, right? Or pay in full. And so it means you own that battery or inverter or whatever it is. And then you have 3.5 months to basically get it to a warehouse or to a designated third party, or basically to the US essentially. So that's really what that 3.5-month rule is. And again, it's an accounting rule. So if you have questions about it, look at it. You can look up the GAAP accounting practices here, for how that is treated. It's not specific to GAAP. So anything else to add there on what I know it's a bit of a confusing thing, but since it came up again, James or Liam, anything you want to call out?
No, I think that's pretty clear.
Just to call on this one point about like lead times here, there's definitely faster lead times on product, Tim. we can chat more about it offline. Depends on what you need and how much you need. But there's definitely manufacturers with the scale to produce things really, really fast. In
Yeah.
terms of like getting a title transferred, maybe not getting it delivered, but then getting it delivered within 3.5 months is still probably doable.
Yeah. Great. Anyone, are you seeing any questions that you guys want to call out?
Yeah,
I,
I think one that was kind of maybe off in the weeds was about the trade consultations with China and the U.S., where they came to some agreements on mostly export controls for different things. I think that doesn't really address battery storage specifically. I think where that's kind of related is that the U.S. has basically paused what were going to be very restrictive export controls on U.S. technology. So even if a let's say, for example, you had a microprocessor chip that was made outside the US. If it was made with more than 50% US IP or tooling, basically that country would have to get permission from the US to be able to export that to a country like China. That's been suspended for a year. So that doesn't really have a direct impact on, battery cells or a battery storage system. Obviously, the challenge is that all these systems, whether it's a battery with its BMS or an inverter with its control systems, if you are using, advanced, chips and processors in those could be subject to those export controls. So I think that's helpful. We'll have to see where we are in a year. I mean, a year is a very long time because I feel like the situation changes about every 2 weeks. So
Yeah.
we'll have to see what that looks like next year.
Yeah, exactly. And I think my just quick take on that is, next year, I think there's going to be a big opportunity also for developing projects without tax credits. If for some reason, let's say you missed the window to safe harbor, which again, you shouldn't, but if you did, I think there's going to be a huge opportunity to make projects economic, where you're basically getting the lowest cost equipment and you are finding ways to increase the revenue generated from battery storage through value stacking, through the electricity prices increasing, through larger systems. So meaning if you were going to install a 1 megawatt hour system, maybe you can actually increase the system size, because then the dollar per kilowatt hour will drop dramatically. And if that site has the demand for electricity enough to monetize that additional capacity, you could increase the return on that project. And then using debt as a tried and true way to increase returns on a project. If you have a 10% unlevered return on a project, well, you can use leverage to dramatically increase that. And our financing is equipment financing or an installment sale. It's very straightforward, and it can help you to also reduce the amount of upfront capital required, which also is essentially a form of debt where you can increase your returns and return on equity that way. So that said, I am pretty bullish on 2026, and for us who are those like GridVest who's selling batteries, so many customers have already safe harbored that we have a lot of opportunity to sell let's say FEOC products, and those are going to be the best price. And there are obviously going to be another subset who we sell FEOC compliant products to, but I just want to the sticker shock is real, right? The price is dramatically higher, and so that tax credit is going to have to more than cover that increase in cost for it to make sense. Otherwise, they're just going to say, forget that.
Yeah, I think the other thing we're going to start to see with this is, with the big beautiful bill. Yeah, again, talk to your attorneys, but it does appear, and I think like Dirk and Brad were talking about this in the chat. It does look like there is, potential to take 100% bonus depreciation in 1 year for BESS projects. So there are going to be other financial levers that are going to start getting pulled more regularly, that can make projects pencil in ways that they previously couldn't, right? And it's just a matter of shifting how you're penciling the projects, right? I like to call it fancy math or magic math, but accountants would just say it's real math.
Yeah. And again, just want to, and I do on that note too about the equipment cost. Another reason to buy this year is that, the price of lithium is going up. The supply of cells, even in China, is going down, meaning the 314 amp hour cells is very, very hard to get right now. And so there is probably, even forgetting about the fact that you're losing tax credits, the actual battery costs per kilowatt hour, even out of China, are going to go up next year. Plus, you have the additional Section 301 tariff going from 7.5% to 25%. So there's going to be a number of reasons where the cost of equipment goes up. We, again, have access to batteries that are already in the US. They're made in China, but they're already in the US, which could be ways that you could still lock in tax credits and safe harbor with batteries today, meaning you're not paying increased tariffs, you're not facing the increased prices due to lithium or shortages in cells, and they're already here, so you don't have to worry about shipping and logistics. So just want to reiterate that. Talk to us here. You can scan the QR code or go to this to basically submit a project. Go to our website as well, gridvest.com, and click get a quote. We will get you, pricing as soon as we can. We're very, very fast on that. You don't need to put a lot of details in. We just need to really know location, size, warranty length. Do you need backup power or not? Do you want an EMS quoted or not? Pretty straightforward stuff. We'll give you quotes even before we sign an NDA. So it's really easy, and we'd love to hear from you. So with that, I think we'll wrap. Unless any final comments from you, James or Liam?
Yeah, I mean, I would just add, I think, a lot of people sort of view this as sort of Y2K. It's like the world's going to end December 31st, and there'll be no storage projects next year. I think that's a very dim view. I think there's lots of potential, and I think especially with the amount of load growth that we have happening in data centers, EV charging, electrification, there's a tremendous demand for energy, and that's not going away. Like, that's going to stay. So even though we have all these complexities to deploying storage, the need for it is not disappearing. So I think then for developers specifically, the question just becomes, who is your customer? And in many cases, we are working with customers who don't care about the tax credit. They're, for them, the value of storage is the speed and the ability to get capacity on site rapidly. And so they're willing to pay almost a premium for that rather than waiting for utility interconnection. So I think there's lots of customers where this is not a linchpin issue, and there's alternatives to that compared to just a traditional investor who's looking for a project to cash flow.
Yeah, well said. And I think, as you showed in your chart, right, solar and storage is deploying faster each year than any other source of energy. So it's going to continue, I think, for sure.
Yeah,
James,
it's the only thing they can deploy, I think, because you look at gas turbines; they now have timelines out that are 5 or 6 years for procurement. Right. So it's the only thing you can buy.
Right, and the fact that you can put it, if you own a building, you can put it on your own site without pretty easily is a pretty attractive way. Also adding in the backup power need, which we're not talking about enough, how the value of a microgrid, the value of resilience, the value of not having going down when there's a blackout, which are going to continue to be more and more frequent, especially in places like California with natural disasters and climate issues, but also with high winds and fire risk. So totally agree. And James, any final thoughts from you?
No. Give me a call. Let us know how we can help.
All right. Well, thank you all for tuning in. Appreciate you sticking around to the end. We had a really strong showing, and thanks for all the questions. We'll be getting a recording of this out to everyone, and just let us know how we can help. We really want to be a resource for the industry. Our whole mission for existing is making battery storage deployment easier and microgrids more transparent. And if you have an idea for us, or a supplier we should talk to, or a project that might need batteries, please, again, let us know. So thank you all. Have a great rest of your Wednesday, and hope to talk soon.